video on debit spreads and how you can use them in your trades to reduce some of the risk you take. They're pretty straightforward. Um, their debit spreads are involving two contracts, so you can use this in either calls or puts, whichever strategy you'd like to use. The structure is very simple. You take a contract, you buy one. Say, for argument's sake, you're buying a contract for $3, and you sell one in the same date period further out. So you say, selling one for $1. So your debit spread, simply a $2 debit. Your buy contract in this case is always more than your sell contract, giving you the debit spread, the spread that carries a premium in which you pay for. The contract selection is also important, as the debit spread do cap your potential gains. The difference between the two contracts is your maximum gain. In order to figure this out, it's pretty simple. So you say stock X is $100, and you think it's going to go to $120 next week. So you buy one contract at $110, say it's $2, and you sell one contract at $120 strike for $1. So your cost of this debit spread will be $1. Your maximum gain on this spread would be $10, because you simply take the contract you sell, $120, and subtract it by $110, the one that you buy. This gives you $10 of space in between. So if StockX closes Friday at $120 or more, your spread would be worth $10 or 1,000%. In this case, you're risking $100 to make $900 in profit. Spreads are tradable just like regular options with a slightly higher bid-ask spread. So just take that into consideration making the trade. It's typically easier to use more liquid stocks like SPY, Apple, etc., than to take some of the lesser known names to play these spreads in. But there are some benefits and drawbacks to playing spreads. Spreads do reduce the theta burn on your stock trade. They allow you to play some bigger ticker names like Amazon, Netflix, etc., because you're just playing the price difference between the two contracts, not the price of the contract itself. I could show you that a little bit in a second. And you're going to reduce the initial outlay and reduce your risk as well. The downsides of the spreads are pretty straightforward. You have an upside potential that's capped, so you can only make so much on each trade. And if you get a huge move, you could possibly miss the bigger move on a naked contract. But in the same token, your spread will be up quite nicely, so you'll be happy with it either way. So we're just going to take an example I made a few weeks ago. This is an example on Netflix. Netflix at the time was $4.98 a share. The weekly call was the weekly call, one deviation out of the money was $8.28. That was the 500 strike. Delta was 47, theta was minus 65. 1218 call debit spread, giving you an extra week of time. One deviation out of the money was $3.80. So this was taking the 1218 monthly 500, buying the 500 and selling the 510. The delta on this trade was 12, and the theta on that spread was minus a penny. If you see the chart below, if on the first day Netflix moved by the dollar amount below, this would be the theoretical value of your play. Now, taken into effect on the larger moves, the Greeks play a little more of a role, so more of a theoretical example. The prices probably be a little bit higher of your profits, but if Netflix moved up $1 that day, so the share would become it would be $4.99.50. Your $500 call would actually lose value because of the theta burn involved. The spread be about 5%, which is a nice day. Netflix goes down $1. Your call is down 14%, where your spread's only down 3%. So you reduce some of your risk with the spread if the stock doesn't move all that much, where with a call, you'd lose money both ways. If Netflix moves up $5, your call will be worth about 10, so you're up about 22%. Your spread will be worth 435, so you're up 15%. So either way, you have a nice gain. If you get a big move, the call would be up double, probably likely more with IV increase at $17, and your spread would be up 65%, over $6. So just keep in mind this example, you also have an extra week's time in your spread, so swinging it a few more days is a lot more bearable. Intraday swings are not measured in this example, nor IV pumps cannot be easily calculated. Also, the delta will increase as the bigger move goes on, so those moves towards the end are definitely going to be a little bigger, especially on the naked call side. Also note that the 500 to 510 call spread max value is $10, so Netflix must expire at 510 or higher to get the full value of that spread. So once you get to this point, 620, maybe 720, you might want to start taking some profits. because then you'll have to just wait out the contract to expire. Pretty much what I have for this. If you have any questions, feel free to comment. Thank you.